Welcome to Real Estate Radio Power Investing, an informative and engaging hour discussing everything you need to know about the world of real estate investing. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate Radio Power Investing, Tom K. Wilson.
Always nice to have you. Thanks for tuning in to our Real Estate Radio Power Investing program, where we empower you with the education to maximize your investing success. We're broadcasting from our Wilson Investment Properties headquarters in Silicon Valley. I'm Tom K. Wilson, your host for this weekly program on real estate investing. If you can't make the live show, you can catch our podcast on TomWilsonProperties.com or on iTunes or on YouTube. If you go to TomWilsonProperties.com, you can sign up for our weekly newsletter on what's happening in real estate in the country and how what's going on in the world of economics that applies to it as well. Also, by signing up, you can get access, become part of our client base, and get access to our syndication offerings, which generally are only available to those who are signed up with us. That's where you can invest in syndications, typically for as little as $50,000, that are properties that normally only large investor or institutions can get access to. We have a team and partners around the country that are looking for all of these properties, the best ones, sifting through them, vetting them, doing the due diligence to get the best ones and provide it to our investors. We've provided 15 so far in the last 3 years, and we have 130 mil under management, and we're just really enjoying being able to provide great value opportunities to our investors. Also on our website, TomWilsonProperties.com, you can go review and look at all of our past podcasts and web and broadcasts that we've done. With such folks as Bruce Norris, Dr. Doug Duncan, Sean O'Toole, and many other folks, Robert Kiyosaki, Kim Kiyosaki, many of their advisors, that Kenny McElroy, and others that are experts in their field. And in our fifth year here of Real Estate Radio Power Investing, we're pleased to bring those guests and those experts to you so we all can learn. And indeed, I haven't done a program yet that I haven't learned from it myself, and I love learning. So that's what keeps me going every day. We're very fortunate to have today a new guest, Madeline Schnapp, who is a former geophysicist, but now in the last 5 years is the Director of Economic Research for PropertyRadar, that is founded and owned by Sean O'Toole, a good friend of ours who's been on the program several times, and it's nice to have Madeline. She comes with high recommendations from Bruce Norris and Dr. Doug Duncan, and we're glad to have her on. And as everyone knows who's listened to the program, we're a big believer in understanding and following the economy as best we can, because it's even a tighter coupling it seems to be these days between real estate markets and the general economics that are going on in the country and world. And the better we understand that, the better chance we have of making good investment decisions. Madeline has got degrees from Stanford and UC Berkeley and University of Colorado. And it's wonderful, Madeline, to welcome you to our program.
Well, thank you for having me.
So I know you probably get tired of answering this question about how geophysicists made their way into economic research. However, I must say that there are very few real estate investors who are full-time that I know who started off in that career, and they all changed. So there's nothing wrong with multiple careers, but go ahead, entertain us. How you made this transition?
Well, in my geophysics career, I was tasked with forecasting earthquakes. And so the way we did it in those days, or at least attempted to do it, and obviously we were never really successful, haven't been yet, is you take a variety of indicators, such as prior earthquake activity, changes in magnetic field, changes in gravitational field, radon levels in well, animal behavior, throw it into a big stew pot, stir it, add a bunch of very complicated statistics, and come out with a forecast. So, and I did that for the first 10 years of my life, and it took me all over the western United States, and I had a great time doing it, but we were never really successful at predicting earthquakes, particularly on the San Andreas Fault. So I had the opportunity to work in a company where they were looking for market forecasting. So I started that career by taking some of my geophysics and statistical talents and applying it in that field. And I was looking for, this is the early days of the Internet, and ARPANET in particular, and was looking for mentions of technology names in an attempt to see if when those names became statistically significant, then it might indicate an interest in that particular field. And then we'd use that to determine what kinds of investment would be made in that particular term or in that particular technology. Well, that turned out to be very successful in Linux. And particularly Red Hat Linux took off. And since there was no information in Linux, a lot of book publishers were interested in that information and began writing books about it. So that sort of led me into thinking about, well, what sort of other things can we do in that particular industry? And what I discovered was that a lot of these mentions began to crater just before the tech bubble burst, and I gave that information to my employer, and I got fired. So, because I was right, and he didn't want to hear it. I wasn't fired. He offered me a job in Boston, Massachusetts, and I live out in California. So I left, and then from there decided I wanted to take that geophysics application into a field where they didn't really care whether you were giving them good news or bad news. They just cared that you gave them the right direction, and that was the hedge fund industry. So for the next 15 years, I worked for TrimTabs Investment Research, writing about the direction of economic indicators as a sort of as an environment for their high-frequency trading signals that they sold into the marketplace. So that's how I made that transition, and I enjoyed it a lot. The people that I wrote my research for didn't really care if it was good news or bad news, which was great, and they just wanted to know the direction. We were happy to provide that. So then I had the opportunity.
Because many markets can make money going up or down, right? So
yes, right. And so that company was sold, and I had the opportunity to work with Sean O'Toole. He was one of my indicators, so I would get the foreclosure statistics from him. And between TrimTabs look at some of the proprietary indicators, we had one that looked at job postings, and another one that looked at the withholdings from income tax withholdings as a proxy for income. Both of those indicators were cratering. Meanwhile, foreclosures were going through the roof. So we took that information to take a look at what might be going on in the economy just in the lead up to the housing bubble bursting, and throughout 2007, the company was issuing, leveraged bear calls, and that turned out to be a very profitable call. Anyway, the company was sold, and I talked to Sean, and he was interested in having an economist come work for him. So that's how that came about.
Wonderful.
And so
yes.
back to your question.
Well, I was just going to say, I was just going to insert there while you mentioned Sean that. He was certainly the first one I heard in 2007 who, of course, he coined the term shadow inventory, and he was the first one I heard that said no, the reason that got in trouble was because it was really a credit bubble that masked all the other metrics and normal business cycles that should have taken us down sooner.
Driven by an environment of artificially low interest rates. And so, the key for us to all of this is what is the big elephant in the middle of the room that's driving, all of this flow of money in particular directions, and then laying the groundwork for bubbles that emerge. And that's the Federal Reserve.
Yes. I saw recently that there were right? 3 of the central banks heads were all met together at where they go at Jackson, I guess. And it's hard to not look at that picture and think, my gosh, they have more impact on the economy of the world than all the prime ministers and presidents.
Well, when you control money, really, which is the amount of time that people spend on this earth, so really you're controlling behavior. I mean, that's the most powerful thing you can control, and they do that for good or for ill. And anyway, as a matter of fact, I'm of the opinion that the primary drivers of any sort of inflation is the Federal Reserve and their manipulations of money. So. And I think part of what we're seeing today is a direct result of their monetary policy.
Well, Doug, when he was Duncan out here recently to speak to one of our groups, and I got a day with him, and he said that frankly the Fed picks this idealistic 2% inflation rate, but he said I've never really seen any great justification for why that number. Frankly. What's wrong with zero?
Well, because the Feds need money. Let's take a look at what Keynes said, decades ago. By continuing a process of inflation, governments can confiscate secretly and unobserved an important part of the wealth of their citizens. By this method, they not only confiscate, but they confiscate arbitrarily, and in the process impoverish many and enrich some. So John Maynard Keynes, the father of basically the economic philosophy by which most in this country subscribe to, called it what it is. It's theft. The government is taking 2% of your money and transferring it into their coffers to do with what they want to do with it. And I would argue that 2% inflation is not, what we're seeing is not 2% inflation. That's what the government would like you to think that it is, that it's in fact much higher than that. And so anyway, that's another sort of, point of discussion.
And what are some of those other factors they're not including?
Well, if you take a basket, I happen to like John Williams and his work with shadow stats. I don't know if you're familiar with it. But if you take originally back in the 1980s, inflation was computed by using a basket of commonly sort of consumed goods. And were weighted arithmetically, and then an inflation rate was calculated. And then what happened is that the cost of living indexes are used in the government for a variety of increasing payments for a variety of things, like Social Security and Medicare and veterans benefits and things like that. And it was decided that there was a problem with the way they were calculating inflation, which is another way of saying that. Go ahead.
Madeline, let's pick it up after the commercial. We have Madeline Schnapp with us today, economist for PropertyRadar, and we'll be back in just a moment on Real Estate Radio Power Investing.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
We have with us today Madeline Schnapp, who's the Director of Economic Research for PropertyRadar, which is founded and known by Sean O'Toole, that many of our listeners know. Madeline, sorry to have to cut you off there before the break. We're talking about how the inflation is kind of created, and that originally there was a basket of items that were tracked that now have changed. So how they decide what to put in and what to take out, and so that the what they report as inflation is really not the real inflation.
Correct. And so before we go further, let's define inflation. So I'm looking at a dictionary here written in 1951, and their definition of inflation is an increase in the amount of currency in circulation, resulting in a relatively sharp and sudden fall in its value and rise in prices. So I subscribe to that definition of inflation because that is basically, in the purview of the government and how the Federal Reserve, manages our money. today...
So it ties to how much... So it ties... Well, the key words I hear that is the amount that's in circulation.
Correct. And the Federal Reserve has direct control over that. So today's definition, if you take a look all over the place, inflation is the rate at which general level of prices for goods and services is rising, and consequently the purchasing power of currency is falling. And I would argue that that is a result of Federal Reserve actions in relationship to the money supply, as opposed to, we just have this sort of thing that's happening out there, and the government is just responding to it. So with that definition in mind, let's go back to our discussion of what's happened to the measure of inflation. So in the 1980s, you had a basket of goods that was weighted arithmetically, and then they came out with their inflation rate. And then somewhere along the line, as they began to look at, rapidly rising standard of or cost of living, and then having to adjust payments out like Social Security and veterans benefits and things like that, Greenspan and I think a guy by the name of Boskin got together and decided, we need to change this in order to reduce the rate at which these things are increasing. Now, that's not what they said to the public. They just said, well, we think this is sort of outdated. So the first change that was made is that basket of goods went from an arithmetic weighting to a geometric weighting, and pretty much it became a black box. It was no longer something that was, easily sort of dissected. And then further on down the line, you had the problem with substitution. So what happens if all of a sudden you've got this TV, that's got tubes in it, and it becomes a flat screen TV, and the original TV cost X, the new TV costs Y, and those prices are changing very rapidly. So then they employed what's called a hedonic adjustment, meaning, well, I'm going to get rid of this because I like this better, and this thing that is better gives me, a greater sense of happiness or feeling or usage or whatever. And that became even more obtuse in terms of how they were computing inflation. So that's sort of where we are today. And there are several people now that have gone back to more of an original way of computing inflation, using a basket of 50 commonly used items that we all consume and taking a look at that. So that rate of inflation is running at about 10% per year. The official government rate that they would like to see is 2%, and right now it's oscillating around that. The problem with that is that it's really, to me, it's sort of dishonest. And if you take a look at some of the increases in things that some of us purchase but others of us don't, and I'm going to divide that along age. So if I'm a person that's under 30, my college tuition costs have increased 197% since 1995. Medical care has increased 105% since 1995. Food and beverages are up 64%. Housing's up 61%. Now, if I'm over 50 and I already have a house, I'm, approaching Medicare age, and I already have a, college degree, I'm not experiencing any of that inflation. So, I have a lot of issues of, in terms of what's going on. The millennial population of 75 million or so is subject to, horrific inflation, where baby boomers are not. So, and that, really comes down to what the government has done, which is artificially drive down interest rates to the lowest we've ever experienced, but the millennials don't have accumulated assets to take advantage of that.
Very interesting. Madeline, we'll be back here in just a moment with more on inflation and the economics that affect real estate on Real Estate Radio Power Investing. We have Madeline Schnapp with us today. Stay with us. We'll be back in just a moment.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Pleased to have Madeline Schnapp with us today, Director of Economic Research for PropertyRadar. And we're talking about a lot of those kind of macroeconomic concepts that have an impact on real estate investing, and that's why we like to learn more about the economy, and so to help us make better decisions. So Madeline, we talked quite a bit in the last one about inflation and how that's defined and how it's changed and how you have to be careful with the numbers that you hear not being the actual number, and in fact your loss of value may actually be more than what's being reported. So let's talk about where things are headed. Do you think it's more likely that we're going to run into a hyperinflation, that we're going to have a deflation, or that we're going to stagnate? And talk a little bit about that, if you will.
I don't believe we're going to be heading into hyperinflation anytime soon. Certainly, there have been spectacular examples of advanced Western economies that have experienced hyperinflation. The Weimar Republic hyperinflation, when $1 trillion marks wouldn't buy a loaf of bread, certainly comes to mind. And that inflationary period basically destroyed that economy. But I don't think that was primarily the result of World War I and then a horrific treaty that burdened the German economy with payments they couldn't make, so they started to print. So I don't really see that as a threat to us. But what I do see is, I think as prices continue to increase, and we talked about some of those prices in your last segment, things like tuitions and healthcare and food and all of those things continue to increase. They're really going to begin to squeeze purchasing power, particularly for the millennials that are faced with rapidly rising housing costs and rapidly rising rents. So, and I don't see that. I don't see real estate is going to continue to appreciate, I think, simply because you have demand, not only demand coming from people earning more wages, but also from just demographic increases, but you're not having supply being generated in enough quantity to meet demand. So I see prices continuing to rise more rapidly than wages, which really puts the squeeze on people that don't own homes and are subject to things that rise like rents. And so that's certainly my worry going forward. And the feds are getting ready to raise it.
Why do you think we will not have hyperinflation? There's certainly some economists that have been predicting it for ages, and they still are. So why do you think we're not going to go into it?
Because the U.S. dollar is still the cleanest dirty shirt in a suitcase full of dirty shirts. And thank you, Mohammed Al-Arian, for that quote. And it just is really apropos. It's not that we aren't creating more debt that we can possibly ever service. It's just that when you print a dollar, there's an insatiable demand for that dollar out in the marketplace, and I don't see that changing anytime soon. So, it doesn't seem like the euro is going to be a place to, invest in the future. It doesn't seem like, the Russian economy or the Chinese economy. And so, when you look at all the viable candidates, you come back to the dollar. And so I don't see that changing.
So you don't think we're going to lose you don't think we're going to lose the world reserve currency? We just got another few seconds in the segment.
Yeah, not anytime soon, no.
Okay. So you think we'll probably kick the can down the road for the foreseeable future because of our relative stance to other world markets?
Correct.
Okay. All right. When we come back, we'll ask about our debt and servicing that, and a few more things about macroeconomics from Madeline. Stay with us. We'll be back here on Real Estate Radio Power Investing.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
It's a pleasure to have Madeline Schnapp with us today, the Director of Economic Research for PropertyRadar. So Madeline, most real estate investors that I know, and certainly I've been a proponent of some time, have not been certainly investing for long-term hold in California high-end cities for quite a few years, in fact, decades for many. unless you're doing development or something that has a big lift, as we call it. And in that case, it's a different ball game. But just during the break, you were talking about looking at the median price houses around major corporations. Can you tell that again for our listeners?
One of the things that was kind of interesting to me is that as prices go up, sales were beginning to go down. And in the Bay Area, for example, we were looking at over the summer, and year-over-year sales levels were down about 10%, which was kind of curious to me. So we began looking a little bit more closely at, okay, let's take a look at median prices in a 5-mile radius around key corporations. So first we took a look at Google, and the median home price within 5 miles around Google was $2.4 million. I just about fell out of my chair. It was a 2-bedroom, 1-bath house built in 1949 on a very small lot. I mean, who bought that? Well, somebody did. These were median home prices of homes that sold over the period. I think it was July, August, and September is what we were looking at. So then we hopped
2017.
2017, just recently. So then we hopped down to Cupertino and took a look at 5-mile radius around Apple, and the median home price down there was $1.8 million. At least that house was built in 1956. It wasn't built in 1949.
Real bargains. That's a bargain.
And then we hopped up to Amazon in Seattle and took a look at that, and the median home price up there was considerably lower, still high, $857,000. But for that, you got a 2,000 4-bedroom, 2-bath house. And Amazon recently made an announcement that they are looking for a second headquarters, and one of the reasons is that the cost of living has gotten too high in Seattle to attract quality employees. So they put an announcement out there, and a lot of cities are competing for Amazon's attention. Dallas is one, Atlanta, Georgia is another, Nashville, Tennessee is another, and it'll be interesting to see how all that plays out.
It will. They know they stated that they wanted to had to be 1 million population, but there are 250 cities that applied, so everybody wants a piece of Amazon, right?
Right. And then we took a look at Reno, and Reno's booming, and their real estate has been going up. Prices have been going up by double digits now for a couple of years due to the fact that Tesla moved up there. They were kind of the canary in the coal mine, and then Amazon moved some facilities up there. Apple moved some facilities, Google moved some facilities, and all three of those companies are expanding their presence in Reno. So the question that I have is, at what point and at what price point do qualified employees just say, we're not doing this here anymore? We're not. When there was a picture in the newspaper of Rankstorth Avenue in Mountain View, wall-to-wall RVs, and when that becomes affordable housing, at what point do people just go, we're not living here, we're going to go somewhere else? And at what point should these companies begin to look at perhaps locating facilities in less expensive areas so they can, so people can live there without having to live in an RV, or commute 2 hours? So that's, and I think that, Amazon, as they have been a leader in just about everything, is beginning, to point the way towards looking for viable alternatives to the Bay Area or Seattle or wherever they're located that, the median income can't possibly afford the median home.
Indeed, we have Wilson Investment Properties for our commercial syndications. We find that nothing for long-term hold in the high-end metros on the coast, make any sense. We can get double those rates in Sun Belt and other cities. So that's why we've been doing that. I hate it. There's 62 corporations that have moved their headquarters in the last decade from California to Texas, and certainly cost of living is one thing, but business friendly is certainly another. A little bit less government intervention.
Well, and my son just moved to Murfreesboro, Tennessee, to attend Middle Tennessee State University. So I went out there to take a look at places, out there, and I was stunned at the price of homes. Murfreesboro, Tennessee is about 25 miles south of Nashville. And, I'm selling a condo up here for $320,000, and I can buy 2 townhomes out there for that amount of money. They're twice the size. And rent them. And
of course, you have to go back. You have to go back even longer than a decade or so. It was really, kind of by the time we got to the 80s, it really didn't make any sense to be long-term hold here. Madeline, if I can interrupt you, I want to catch, since we only got a little bit about a minute left in this segment, I want to ask you about our debt. Do you think the fact that if our rates go up too high, we might not be able to afford our own debt service as one of the factors that constrains us from going into hyperinflation? And do you think there's any chance of paying off the debt, or are we just going to have to swallow that we live with this debt service forever?
No, I think, in Japan what's happening is that their standard of living is contracting, and the other thing that's happening is young people aren't having kids because it costs too dang much to set up an independent household. So there's some significant costs to debt. Now Japan's debt to GDP ratio is well north of 200%, and ours is bouncing off of 100%. But our debt service is still really low. And, the trajectory of the Fed's raising interest rates is still very, very slow. And so I don't think we're going to really see that as an issue, certainly not for next year. Further than that down the road, it just depends on what the trajectory of interest rates are. And I just don't see that as a big threat, right, in the near term. So for long-term buy and hold, I don't know. That's a tough one.
Yeah, it is. Well, as Doug Duncan says, he's been starting since he knows most people are going to ask him when's the next crash. His first intro comments lately have been, all expansions end. I just can't tell you exactly when it'll be.
Exactly.
We'll be back for a little wrap-up segment here with Madeline Schnapp in just a moment on Real Estate Radio Power Investing. So stay with us. We'll be right back.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Well, it's been a pleasure having Madeline Schnapp with us today. As our listeners know, I've been a long-time fan of Sean O'Toole and his Foreclosure Radar, and now Property Radar. Madeline, how is Property Radar utilizing your research, and can the public and our subscribers get access to some of that? Clearly, Sean and Property Radar recognize that even though they're largely a data reporting based business, that it's important to understand what's going on in the world of economics as it applies to real estate.
Well, how I use Property Radar is Property Radar grabs public record data on properties as soon as they are sold or listed, or something happens to that public record, like there's a new loan, or and in addition to that, there's information about the size of the properties, who owns it, where it's located, tons of information that you can use to generate, data analysis, marketing alerts, anything that you need as an investor or a real estate agent. I use it in the back end, and I like to look at longer term trends. So what are sales in an area? What is the median home prices? What percentage of those sales are distressed versus non-distressed? What's foreclosure activity doing? What is the number of cash sales, and how is that changing? So I take a look at the big picture data, both at state level, county level, even zip code level, to ascertain how well the real estate market is doing, how it's changing as a function of time.
And does that get reported and made available on Property Radar to its subscribers?
Yes, we have a blog, Property Radar /blog, and you can find our reports there. And I'm working on one now, kind of a look forward and a look back, or look forward, California property trends. And that'll probably be available next week.
All right. And if someone wants to subscribe to Property Radar, go to PropertyRadar.com.
Go to PropertyRadar.com, and there's a free trial if you're curious about the product. And if you're curious about more information, there's a support link that'll take you right to somebody that can answer all your questions.
when we were in the house business, we used it extensively, and all the smart folks I know who are in the business use PropertyRadar, so we highly recommend that.
Well,
Madeline,
I
thanks
bought
so
my
much for
properties using PropertyRadar, so
oh, good.
I consume my own
right.
product.
Well, good. Madeline, thanks so much for being on the program today. We'll have Madeline back again. Go to TomWilsonProperties.com, and you can look up all the podcasts with Sean O'Toole, Bruce Norris, Dr. Doug Duncan, Robert Kiyosaki, Ken McElroy, and on. Wonderful guests that we're very fortunate to have. And also by going on, you can sign up to our newsletter, which gives you a weekly update on what's going on in the world of real estate in the United States, and as it applies to economic cycles and what's going on, and also gives you access to commercial and multifamily syndications that you can be a part of for $50,000 a share. So we look forward to your questions. We're certainly delighted to have Madeline on today, and we look forward to you being back on our next program. And remember, the only thing that matters is what you do next.